We're into the mid to late afternoon on Wall Street, and you're watching Storm Stock Solutions. I'm Grant Mercer. The tone this hour: cautious under the surface with pockets of speculative energy in AI and autos, and a growing focus on how much silent pain consumers can really take heading into 2026. Let's start with the macro story that's hovering over the 20 tape. According to MarketWatch reporting, economists are bracing for what they call a messy November jobs report. The concern isn't just the headline payrolls number. Pros are watching whether the combined data shows a sharp deterioration in what's already a fragile labor market, or signs that things are stabilizing. That uncertainty is a big reason you're seeing traders stay selective into the afternoon rather than throwing on broad risk. Layered on top of that, another MarketWatch piece is highlighting what 2025 has felt like for households. Tariffs, the AI boom, geopolitical divisions, and a new administration have created a year of strain. And the call is for more silent pain in 2026. That's code for consumers feeling squeezed even if official inflation is cooling. For the equity market, that keeps a spotlight on anything tied to discretionary spending, big-ticket purchases, and the health of the middle-income shopper. On the opportunity side, housing is front and center. A widely read MarketWatch column about whether a son should buy a $600,000 house after the Fed's rate cuts is capturing the mood. People are seeing slightly better mortgage rates, but they're still nervous about job security and affordability. For traders, it's a reminder that rate-sensitive areas like home builders, mortgage lenders, and housing-adjacent retail are in a tug-of-war between improved financing conditions and jittery consumer psychology. You also have a powerful sentiment story in Tesla. MarketWatch notes the stock is flirting with new highs after a bold prediction that the company could one day reach a $3 trillion valuation. Even though shares have pared back some of the initial spike, optimism around Tesla's AI and autonomous driving ambitions is clearly drawing in momentum money. This is where professionals are asking, is this simply another sentiment-driven leg higher in the AI autonomy trade? Or is the market baking in a long runway of execution that's hard to justify in the near term? Either way, it's a key barometer for risk appetite and growth in EV names. On the flip side, we've got some clear weak spots to handle with care. Costco is under the microscope after an analyst at Roth, highlighted by MarketWatch, took a contrarian stance and slapped a sell call on the stock. The bear case centers on slower membership trends, tougher competition from Walmart, and even demographic factors like people delaying starting families. For a stock that's often treated as a steady, defensive retail play, that kind of downgrade raises questions about how bulletproof the big box membership model really is if consumer silent pain deepens. Another area of pressure this hour is enterprise software. ServiceNow is sinking toward what could be its worst day in roughly 11 months. Reporting from MarketWatch points to worries that the company may get more acquisitive in order to spark growth. For investors, that raises the risk of dilution, integration headaches, and uncertainty about organic momentum. It's a reminder that even in higher quality software names, the market is quick to punish any hint of growth at any price strategies, especially in an environment where borrowing costs, while easing, are still not back to the ultra-cheap levels of a few years ago. In the background, there are a couple of under-the-radar stories that could matter more if conditions shift. One is China. MarketWatch is reporting that weak retail sales and penny-pinching households are forcing Beijing into very targeted stimulus, including digital yuan incentives, with mixed results so far. If that narrative intensifies, it could influence everything from global commodities to luxury goods and multinationals that rely on Chinese consumers. The other is a quieter, more structural tech story. Some once reliable information and its services, names like FactSet and Gartner, have been among the S&P 500's worst performers this year, partly on fears that AI will eat into their businesses. But according to MarketWatch, there are voices on Wall Street arguing these are sticky, resilient franchises that can adapt to AI rather than be destroyed by it. If that view gains traction, we could see a rotation within tech, from the pure AI darlings back into the picks and shovels analytics and research providers that have sold off. Into the next hour, I'll be watching three things: how rate cut optimism and housing jitters play against each other, whether Tesla can hold on to its AI-fueled enthusiasm, and if the pressure in names like Costco and ServiceNow starts spilling over into the broader consumer and software complexes as we head toward the close. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady.